Money has always followed power, and power has always consolidated around money. For more than a century and a half, the story of the American economy has been shaped not by accident or natural market forces alone, but by calculated decisions made in boardrooms far removed from the lives of ordinary citizens. The banking dynasties that emerged in the 19th century built empires not simply through shrewd investments or honest labor, but through strategic positioning at the intersection of government policy, international finance, and industrial expansion. These were families who understood that control over credit, currency, and capital meant control over nations themselves. From the Rothschilds of Europe, who pioneered international banking through 5 brothers stationed across London, Paris, Vienna, Naples, and Frankfurt, to the Morgans, Rockefellers, Warburgs, and Mellons, who dominated American finance during the Gilded Age. These dynasties created networks of influence that persist in modified forms to this day. Understanding their rise and the crises they either navigated or precipitated is not conspiracy theorizing, but historical documentation, drawn from Senate investigations, financial records, contemporary journalism, and the testimonies of those who witnessed their power firsthand. Before you finish this documentary, you will see documented evidence of how financial concentration shaped the Panic of 1873, the crisis of 1907, the Great Depression, and beyond. And I encourage you to watch until the end to grasp the full scope of these connections, and to comment below where you are watching from, your city and country, so we can see how global this conversation truly is. The dynasties began their ascent in an era when the United States was rebuilding itself after the Civil War, when railroads stretched westward and industrialization promised boundless prosperity. Meyer Amschel Rothschild, born in 1744 in the Frankfurt ghetto, established the template for dynastic banking power by sending his 5 sons to establish branches across Europe's financial capitals. By the 1820s through the 1870s, the Rothschild family dominated European finance, creating the first true international banking network, where transactions could flow across borders with a speed and secrecy unavailable to governments or competitors. Their strategy was revolutionary for its time, keeping control strictly within family hands and maintaining absolute confidentiality about the size of their fortunes, a practice that allowed them to move markets without revealing their positions. The Jewish Encyclopedia of 1906 noted that this practice of establishing family branches in different financial centers was later adopted by other Jewish financiers, including the Bischofsheims, Perers, Seligmans, and Lazards, creating a web of interconnected banking houses whose interests often aligned across national boundaries. In America, parallel dynasties were forming with similar ambitions and methods. The Warburg family, originally from Germany and claiming Venetian Jewish ancestry, sent 2 brothers to the United States, where they became central figures in the powerful investment bank Kuhn, Loeb and Company. Paul Warburg married Nina Loeb in 1895, daughter of Solomon Loeb, who co-founded the firm in 1867. And by 1901, Paul had taken up permanent residency in the United States as a partner in what Time magazine later described as one of Wall Street's most important and respected banking houses. His brother Felix also married into the firm, and together the Warburgs became instrumental not just in financing railroads and industrial expansion, but in shaping the very structure of American monetary policy, a role that would become starkly evident in the creation of the Federal Reserve System. John Pierpont Morgan represented the American apex of banking power during the late 19th and early 20th centuries, a man whose personal decisions could stabilize or destabilize entire markets. Following his father's retirement in 1864, Morgan built an empire that extended from railroads to steel, from electricity to government bailouts, becoming in effect a private central bank in an era when the United States had no official one. The Panic of 1873 marked Morgan's emergence as the premier banker in America, a crisis triggered when J. Cook and Company, a major investment bank heavily invested in Northern Pacific Railway bonds, found itself unable to market several $million in railroad securities. President Ulysses Grant's monetary policy of contracting the money supply and raising interest rates compounded the problem for businesses and railroads carrying heavy debt. And when Cook's firm collapsed in September 1873, it set off a chain reaction of bank failures that temporarily closed the New York Stock Exchange for 10 days. Between 1873 and 1878, 18,000 businesses failed, and unemployment reached 14%, devastating families from New York, where a quarter of workers lost their jobs, to San Francisco and Virginia City, where silver mining communities collapsed. The panic exposed the vulnerability of an economy without a central bank to absorb shocks, and it ironically elevated Morgan's firm to the forefront of American finance, positioning him as the primary banker for the United States government, helping to refinance national debt and even underwriting army wages. Morgan's strategy, which came to be called Morganization, involved acquiring weaker companies during crises and consolidating them into monopolies that provided stability but eliminated competition, a practice that drew increasing criticism for its impact on workers and smaller businesses while enriching the dynasties at the center of the consolidation. The Mellon family of Pittsburgh built their fortune through similarly strategic positioning across banking, aluminum, steel, and shipbuilding. Judge Thomas Mellon founded T. Mellon & Sons in 1869, and his sons Andrew and Richard multiplied the family wealth through Union Steel, which merged with United States Steel to form the world's largest steel company, and through strategic investments in aluminum and coal. Andrew Mellon's ascent to Treasury Secretary in 1921 illustrated the revolving door between private banking dynasties and government power, a pattern that would repeat throughout American history as financial elites moved seamlessly between Wall Street and Washington, shaping policy that often benefited their own institutions. The Rockefeller dynasty, built initially on oil through Standard Oil, expanded into banking when John D. Rockefeller Jr. became majority stakeholder of Chase Bank, an institution that would become central to American and international finance throughout the 20th century. These families did not operate in isolation, but formed interlocking directorates, sitting on each other's boards, financing each other's ventures, and coordinating responses to market crises in ways that maximized their collective advantage. The concentration of power became so pronounced that by the early 20th century, investigations by Congress, including the Peugeot Committee hearings of 1912, documented how a small group of financial institutions controlled vast swaths of the American economy through a web of corporate board memberships and financial dependencies. The Panic of 1907 demonstrated both the extent of Morgan's power and the systemic risks inherent in a financial system dominated by a few individuals rather than public institutions accountable to democratic oversight. It was against this backdrop of recurring financial panics and concentrated private power that a secret meeting took place in November 1910 at the Jekyll Island Club off the coast of Georgia, a gathering that would fundamentally reshape American banking for the next century. 6 men attended the meeting, traveling under conditions of strict secrecy to avoid press attention and public scrutiny. They were Senator Aldrich, Assistant Secretary of the Treasury A. Piott Andrew, Henry Davison of J.P. Morgan & Company, Arthur Shelton, Frank Vanderlip of National City Bank, and Paul Warburg of Kuhn Loeb & Company. The meeting and its purpose were closely guarded secrets, and participants did not publicly admit the meeting had occurred until the 1930s. But the plan drafted at Jekyll Island laid the foundation for what would eventually become the Federal Reserve Act. Frank Vanderlip later wrote in his memoirs that he was invited to join a small group of men who, at Senator Aldrich's request, took part in a several days conference to discuss the form that a new banking bill should take. And when the conference closed, the rough draft of what later became the Aldrich Bill had been agreed upon. The fact that the architects of America's central banking system met in secret
without public input or congressional oversight during the drafting phase, and that the plan emerged from representatives of the very banking dynasties who had profited from previous crises, raised questions about whose interests the Federal Reserve would ultimately serve. Warburg, whose family maintained banking operations in both Germany and America, became a member of the Federal Reserve Board after the system was established in 1913, continuing the pattern of banking dynasty members occupying positions of official governmental power over monetary policy. The Rothschild family's influence, though centered in Europe, extended into American finance through correspondent relationships and joint ventures with American banking houses. The family had been elevated to noble rank in both the Holy Roman Empire and the United Kingdom, unusual recognition for a banking family that spoke to the political power their financial operations had secured.
The legislative response to the Depression included the Banking Act of 1933, commonly known as Glass-Steagall, which separated commercial banking from investment banking in an attempt to prevent conflicts of interest and reduce systemic risk. The act prohibited commercial banks from dealing in securities and forced institutions to choose whether they would be investment banks or commercial banks, ending the practice of using federally insured deposits to finance speculative trading activities. Goldman Sachs, which had operated both a commercial bank accepting deposits and an investment bank underwriting securities, chose to become exclusively an investment bank, while J.P. Morgan separated into J.P. Morgan & Company for commercial banking and Morgan Stanley for investment banking. These regulations, along with the creation of the Federal Deposit Insurance Corporation, brought relative stability to American banking for nearly 5 decades, but the separation would eventually be dismantled through lobbying efforts by the very institutions the law had been designed to constrain. The Depository Institutions Deregulation and Monetary Control Act of 1980 began the process of dismantling Depression-era protections, followed by the Garn-St. Germain Depository Institutions Act of 1982, which expanded lending powers for savings and loan institutions and removed loan-to-value ratios and interest rate caps that had previously limited risk-taking. The predictable result was the savings and loan crisis of the 1980s and 1990s, during which approximately 1/3 of all savings and loan associations failed, costing taxpayers over $124 billion in bailouts, while the executives who had profited from risky lending practices faced minimal consequences. The post-war period brought a fundamental restructuring of international finance through the Bretton Woods Conference of July 1944, where delegates from 44 nations gathered at the Mount Washington Hotel in New Hampshire to create a new monetary system. The conference established fixed exchange rates managed by newly created international institutions, with the United States dollar serving as the reserve currency backed by gold at $35 per troy ounce. The International Monetary Fund and World Bank emerged from these negotiations, institutions that Soviet representatives correctly characterized as branches of Wall Street before declining to ratify the agreements. The Bretton Woods system operated successfully for nearly 3 decades due to low international capital mobility, tight financial regulation, and the dominant economic position of the United States. But it also concentrated extraordinary power in American financial institutions and the banking dynasties that controlled them. When President Richard Nixon ended dollar convertibility to gold in 1971, it freed international finance from the discipline of gold backing and ushered in an era of floating exchange rates and increasingly complex financial instruments that would benefit sophisticated financial institutions with global reach, while creating new sources of instability. The stagflation of the 1970s, combining high unemployment with high inflation in a way that conventional economic theory suggested was impossible, eroded middle-class living standards as real wages stagnated or declined and mortgage rates soared above 18% by 1981. Housing affordability decreased dramatically,
quality of life indicators deteriorated, and personal bankruptcies and foreclosures increased. Yet the banking dynasties adapted by expanding into new financial products and international markets, maintaining their positions of influence even as ordinary Americans struggled. If you are finding this documentary valuable and want to see more investigations into how financial power shapes our economy, please take a moment to like this video, subscribe to the channel, and activate the notification bell so you do not miss future episodes. Also, comment below and let us know where you are watching from, your city and country, because understanding how these patterns affect communities globally helps us all see the bigger picture more clearly. The deregulatory momentum continued through the 1980s and 1990s, driven by lobbying from financial institutions that argued that Depression-era regulations were outdated and prevented American banks from competing globally. The culmination came with the Gramm-Leach-Bliley Act of 1999, which repealed key provisions of Glass-Steagall and allowed commercial banks, investment banks, and insurance companies to merge, creating financial conglomerates of unprecedented size and complexity. Citigroup, formed through the merger of Citicorp and Travelers Group, became the model for these too-big-to-fail institutions that combined retail banking, investment banking, insurance, and proprietary trading under one roof, backed by federal deposit insurance, but engaging in speculative activities that would have been illegal just years earlier. The concentration of financial power accelerated dramatically, with assets held by the largest banks growing exponentially, while their connections to political power deepened through campaign contributions, revolving door employment between Wall Street and Washington, and lobbying expenditures that dwarfed those of any other industry. Goldman Sachs, which had been a private partnership until its initial public offering in 1999, exemplified the transformation of banking dynasties into modern corporate behemoths, with alumni occupying the highest positions of government economic policy, including Treasury Secretary and positions throughout the Federal Reserve System, creating conflicts of interest that would become starkly apparent during the crisis of 2008. The financial crisis of 2008 revealed the consequences of this deregulation and concentration of power with devastating clarity. The collapse began with subprime mortgage securities, complex financial instruments created by packaging risky home loans into bonds that were sold to investors worldwide, often with fraudulent credit ratings arranged through relationships between investment banks and rating agencies. Bear Stearns, the fifth-largest investment bank, collapsed in March 2008 and was acquired by J.P. Morgan Chase with assistance from the Federal Reserve in a transaction that protected creditors but wiped out shareholders. In September, Lehman Brothers, the fourth-largest investment bank, filed for the largest bankruptcy in American history when the Federal Reserve declined to guarantee its loans as it had done for Bear Stearns, triggering a 4.42% drop in the Dow Jones Industrial Average and threatening complete collapse of credit markets. Treasury Secretary Henry Paulson, formerly chairman and CEO of Goldman Sachs, and Federal Reserve Chairman Ben Bernanke met with congressional leaders and warned that credit markets were close to complete meltdown, with Bernanke reportedly stating, "If we do not do this, we may not have an economy on Monday," requesting $700 billion to purchase toxic mortgages from failing institutions. The Troubled Asset Relief Program that emerged from this crisis funneled taxpayer money to the largest financial institutions, with Goldman Sachs receiving $10 billion in TARP funds, in addition to a $5 billion investment from Warren Buffett, repaying the government in under a year and generating a profit of $1.4 billion for taxpayers, but maintaining the firm's position of dominance. Morgan Stanley received an identical bailout and generated similar returns, while Amerex Express obtained $3.4 billion and repaid with dividends and preferred shares, generating $414 million in profit. The pattern that emerged from 2008 mirrored previous crises in essential ways, with losses socialized through taxpayer bailouts while profits remained privatized, and with the largest institutions emerging stronger than before as weaker competitors disappeared and market share consolidated further.